Boeing shares are lower this morning and down more than 40% year to date. The company now plans to cut 10% of its workforce, or 17,000 jobs, as the machinist strike enters its fifth week. Joining us now with more on Boeing, Ken Herbert, RBC Capital aerospace and defense analyst. And Ken, it's kind of, other than Boeing, it's like the best of times in the industry, worst of times for Boeing. It's really pretty astounding, the dichotomy between aerospace and defense and then Boeing at this point.
It is. It's frustrating and yes, very interesting. You see incredibly strong demand for travel, which has resulted in very strong demand for aftermarket spending, which obviously benefits a lot of companies in the sector. I would just comment, though, that it's not just Boeing that's having supply chain issues and obviously a strike, but there are supply chain issues impacting other companies. But clearly, and the outlook for defense is relatively robust, I would say, and those stocks, I think, have some opportunity as well. So interesting time we're in, and let's hope we're hitting the bottom here and things can start to look better into 25.
If we talk about Boeing, though, whether it's deliveries or production or any of the things that you'd need to try to analyze the financials of the company, can you do any of that right now with the strike where we are?
It's a challenge. I mean, obviously, the free cash numbers in the third quarter with the pre-announcement on Friday, probably not as bad as everybody feared, just because I think there was some decent delivery activity in the quarter, and the strike obviously started middle of September. I think there's really 2 points I would make. First, yes, understanding the cash impact now of the strike, ultimately, but what Boeing will have to pay is a challenge. I think most estimates, and we would agree, are in sort of the $1 to $2 billion a month in terms of the free cash flow impact from the strike. Having said that, that's why I think the announcement on Friday was helpful, with some look at the broader cost structure and look at the ways, obviously the new CEO is able to start to take cost out. But then I think more importantly, it's really about giving investors confidence that as we come out of this, that the $10 billion in free cash that the company had outlined back in 2022 is actually still an option. It's just clearly getting pushed to the right. So I think that's the most important thing, is we need to increase visibility and confidence and how the financial situation can look as we get through the strike and as the industry continues to recover.
If the strike ended and they go back into, what Boeing was doing before the strike, what about the 17,000 workers? Were they always expendable? I mean, if you get rid of them during a strike and then the strike ends, you're missing 17,000 workers. Or did you not need the 17,000 in the first place? I'm confused.
Great question. I think you would say two things. One, there's clearly a lot of these people coming across other parts of the organization, that are maybe not as directly impacted by the strike, which reflects maybe there was just some opportunity there to take some cost out. Second, and Boeing's been very upfront about this, Boeing has kept sort of an elevated workforce through the crisis to be in a position to support, obviously, future rate increases when they layer in. So I think this also reflects just maybe incremental timing risk when you think about sort of the planned production and delivery increases out of the commercial side of the business.
How long will we think about Boeing being sort of outcompeted by Airbus? How can they get back their mojo if they settle the strike and, Ortberg, improve safety and every quality, whatever needs to be done? It just seems like it's turning around an ocean liner in a very small area. I mean, Airbus will probably be the benefit of this for at least a couple of years.
Yeah, I mean, unfortunately, these bets take years to play out across the cycle when you think about the product portfolio. And Boeing is still certainly struggling from the impact of the MAX and the 2019 grounding. So if you look at the narrow body marketplace, which is the MAX and the A320 from Airbus, I think that has fundamentally reset at a 60-40, 65-35 advantage for Airbus. And those tend to be the most profitable programs. So I think, though, Boeing can get its mojo back as it just starts to demonstrate some continued execution and deliveries on the MAX. On the wide body franchise, Boeing continues to enjoy a strong position in that market. Boeing's always had a strong position, certainly in the freighter market. So there, it's basically sort of equal footing relative to Airbus, maybe even a little slight edge still to Boeing. But obviously on the MAX and the A320, we have seen a structural reset there in market share, which, of course, incumbency is very important in this industry. And then as you think about down the road, future aircraft, it gets much easier to sell a replacement than to convert a new customer. So there has been a reset, but doesn't mean Boeing can't hit their cash flow targets.
I mean, Ken, that's the big question I was going to ask. I mean, there are customers who are set in their ways. They have set up their entire operation to work with the Boeing infrastructure. Are there any customer defections you've heard of or rumblings to that effect? Because that would be a much bigger game changer that once that's gone, it's probably really hard to change it.
Yeah, you're right. Switching costs are incredibly expensive for airlines. There's always rumblings, and I think a lot of it is airlines like to negotiate in public. They love to have the ability to play Airbus off Boeing, and that's nothing new. That's been going on for years. So I'm not aware of any large customers yet that have significantly defected or are planning to defect. I mean, keep in mind, I think the MAX, obviously with the changes, is a good aircraft. And when I say good aircraft, it's delivering the efficiencies to the airlines in terms of fuel savings and cost savings. So obviously airlines are having to wait much longer to get the aircraft, but I think the aircraft is performing in the marketplace. So your risk for Boeing right now is you just don't have the slots and you're under-promising or over-promising and under-delivering relative to when you can deliver the airplanes. But switching costs are very expensive in this industry.